Everybody, welcome to JAIIB CAIIB English Medium channel. Today we will be talking about the second part of the most important questions in the module B for PPB, Principles and Practices of Banking. The exam is scheduled on 8th of November. Still we have good time to consolidate our preparation, and via this particular video we will be trying to do that only. So let's get started. First question in front of you. A, B, C are partners in a firm. If B decides to retire from the partnership, what is the primary effect on B's liability for the acts done by the firm before the date of retirement? So such kind of questions, definitely they are asked in the IIBF examination. And we have seen in the last attempt of PPP, that is May 2025, the number of case study based questions have increased. Along with that, we have also seen the numerical based questions. So that's why it is very important for all of you to try to attempt such kind of question as much as possible. So this is just a case, hypothetical case, where we are talking about a partnership firm. Fine, partners in a firm means partnership firm. There are three partners, A, B, and C. Now B has decided to retire. Okay, what will be the effect on B's liability? Whether B will be liable for all those deeds which will be done after his retirement or her retirement. What about the previous scenario, that prior to his or her retirement, whatever decision has been taken by this partnership firm, whether it will be there or not? You have to tell me that before the date of retirement. So first statement states B's liability for the past acts is automatically discharged upon retirement. He or she is free from any kind of liability. B remains liable for all the the past acts until the public notice of retirement is given. So public notice, whether it is given or not in partnership firm, do let me know. B is liable for past acts unless expressly released by the agreement with the remaining partners and firm's creditors. So whether the B will be liable for all those past acts until and unless the particular past acts have been released by a particular agreement. One agreement will be signed which states that B is no longer liable. Whether that is the right answer here. B's liabilities immediately transfer to continuing partners A and C. Or whether what will happen, B's liability will fall on A as well as C in whatever proportion they like. So the right answer for this question will be option C. B will be liable for the past acts. That is for sure. But the liability may go away if they release an agreement with the remaining partners. If B releases an agreement with the remaining partners and the firm's creditors that yes, I am no longer a partner, so let me go away with the liability as well. So I do not have any kind of liability. But if no agreement is signed, then definitely B will be liable for the past acts, even if he or she has retired. So B is liable for the past acts until and unless expressly released by an agreement with the remaining partners and the firm's creditors. So role of creditors is also very, very important. If the if we talk about the continuing liability, retirement from partnership like death does not automatically absolve a partner's liabilities incurred while they were a member of the firm. So automatically you say that once you have retired, whatever you have decided, whatever decisions you have making in the past, they will go away. Your liability will go away. No, answer is no. A retiring partner remain liable to the third party, especially the creditors, for the debts and obligation incurred by the firm before the date of their retirement. So that's why I was telling you firms creditors are very, very important. Release mechanism. So how the particular partner can be discharged from his or her duties. To be discharged from the continuing liabilities for the past acts, the retiring partner B must enter into a novation, that is a new contract or an express agreement. This will be made between retiring partner, that is B in this case, continuing partners A and C, and lastly the creditors of the firm. So all these parties will be involved, and if you want to release partner B based on the retirement, then yes, this mechanism must be followed. Otherwise, he or she will remain liable till the partnership firm is there. Next question, the provisioning in respect of existing loans or the exposures of banks to companies having directors whose names appear more than once in the list of willful defaulters will attract accelerated provisioning of how much in case of substandard or the unsecured ab initio asset if the NPA period is between 6 months to 1 year, which includes the infrastructure loans, obviously. So you have to tell me the exact provisioning norm in case of the substandard asset, which is unsecured ab initio. And the particular question talks about a list of willful defaulter where one of the directors' name is also present. So what will be the percentage of provisioning here? Definitely see your B is the right answer. That is 40%. 40 is the right answer. We have to see that whether the provisioning is for the unsecured loan in the substandard category or the secured ab initio. So the right answer will be 40% here. Let's just quickly see that what exactly are the norms for accelerated provisioning. So if your asset is classified as substandard in case of secured, there you will find the NPA period as up to 6 months. If the NPA is up to 6 months, regular provisioning will be 15%. Accelerated provisioning, no changes there. You will keep on doing the 15% provisioning only. Once the NPA period exceeds 6 months till 1 year, you will have regular provisioning of 15%. Accelerated provisioning will be 25%. As soon as we talk about the unsecured ab initio, here again the time period will differ. Up to 6 months we have different provisioning norms, and beyond 6 months till 1 year you have different provisioning norms. So up to 6 months it will be 25% for all those loans other than infra loans, and 20% for the infrastructure loans. Accelerated provisioning norms will be 25%. But when I talk about the time period for 6 months and till 1 year, you will find the regular provisioning is same, 20%, 25% and 20%. But accelerated provisioning will change. It will increase to 40%. And that is what was asked in your question. Okay, 40%. That's why it was the right answer. Apart from that, we have doubtful category also. So provisioning for doubtful category is very, very important. We have D1, D2, and D3, three categories of the doubtful assets. So one particular asset will be termed as a doubtful one when it is in the second year. The NPA has been, the account has been in NPA till the second year. Once it enters the second year as an NPA account, it will be termed as doubtful one. So for that, your normal provisioning will be 25% of the secured portion and 100% will be for the unsecured portion. Again, the doubtful one category accelerated provisioning is 40% for the secured portion and 100% for the unsecured portion. These two columns are for normal provisioning, right? This one is for normal provisioning and this is for your accelerated provisioning, right? Doubtful two category, if the account is NPA beyond third and fourth year also fine, or entire third year, entire fourth year, your account is in the NPA category, so it will be transferred to doubtful two, D2 category. For that, your normal provisioning will be 40% secured portion and the unsecured portion will be 100%. Accelerated provisioning 100% for both secured as well as unsecured. Doubtful three category, once the account is NPA for more than 5 years. So 5 year onwards, you will have the D3 category where the provisioning will be what? For normal 100, for accelerated as well, your 100%. Okay, so these tables, they are very, very important. Every year question is asked from here. Next we have MSPQR is a textile trading company. The projected annual turnover for coming financial year is 300 lakh. So let's write it down. The projected annual turnover for the coming year, it will be 300 lakh. company requires a minimum of 25% of its projected turnover as total working capital. Okay, so whatever the projected turnover is there, fine, its 25% must go towards the working capital, the total working capital, and a minimum 5% of its projected turnover as the borrower's contribution to the working capital, which is known as margin. Okay, so 5% will be what? Your margin, the margin money. Fine. The working capital to be contributed by the borrower, that is margin, will be dash rupees lakhs according to the turnover method. So according to your turnover method, you have to calculate that what will be the margin. 5% of what will be the right answer. So try to calculate. You have 1 minute with you. You can pause the video and try to answer the question on your own. Try to solve the question on your own. The correct answer will be option A, that is 15 rupees. 15 lakh will be the right answer. How? See, the question is simply talking about the turnover method, which is also known as Nayak committee recommendation, fine, also known as the recommendations, or you can say the first method of lending. So if you have the question of turnaround method and turnover method, or for that matter, PJ Nayak committee method, the Nayak committee method, or the first lending method, right? First method of lending, you will have to follow the same process for assessing the working capital needs of micro, small, and medium enterprises. The method assumes that the certain percentage of period of your projected annual turnover will be required as TWC, that is total working capital. And out of that, a minimum percentage must be contributed by the borrower as working capital margin, or the borrower's contribution must be there. Now, when I talk about this particular explanation where we have the turnover method as the benchmark, you will find the projected turnover which is given in the question as 300 lakh. Okay. And in order to calculate the working capital, you must have the margin percentage with you, which is already mentioned as 5%. Now the borrower's contribution, which we need to calculate, it will be what? The projected turnover multiplied by the minimum margin percentage. So 300 lakh multiplied by 5%, you will arrive at the answer as rupees 15 lakh. A very simple explanation, a very simple answer, a very simple question indeed. But while sitting in the examination, you feel that this is a bulky question and we should leave such kind of questions. So that is a very wrong approach, I would say. Sometimes we have seen these questions have been asked for 2 marks, and after submitting the exam, when our score is 48, 49, we feel that we should have attempted such kind of questions because these are easy questions, direct questions. Okay, so do not get afraid of numericals. Try to solve them as much as possible while practicing the mock tests as well. Apart from this, what we can understand from this example, the total working capital requirement, which was 25%, right? So the total working capital will be 300 into 25%. That will arrive at 75 lakh. Now, when I talk about the maximum permissible bank finance limit, okay, in this particular question only, if somebody asks you that, tell me what will be the MPBF, that is maximum permissible bank finance, how you will be calculating that? Simply stated, the total working capital, which was 25% of your projected turnover, subtracted from the borrower's contribution. Okay, whatever the contribution of the borrower is, or for that matter, whatever the margin is there. So what is the TWC? That is total working capital. 75 lakhs subtracted with the 15 lakh. You will get 60 lakhs as the MPBF, the maximum permissible bank finance limit. Okay. So always remember, whenever you are going for the numerical questions or the formula based questions, try to explore other things also, that if the examiner asks me some other thing from these particular data points, whether I would be able to answer or not. Okay, so next question, which of the following statements are incorrect regarding the legal requirements for your valid consideration? So we have different legal requirements Whenever we talk about the legal terms in PPB, we have different legal terms specifically in module B. So consideration must move from the promisee to the promiser and not from the third party in the case of doctrine of privity of consideration. So what about consideration? Do you know what is consideration? The consideration for an act must always be payment in money or money's worth and cannot be a promise to perform any act. So whenever you have such kind of question, always go for the the concepts which you have retained in your mind. Always start with the basics. What do we mean by a valid consideration? If you can recall that in the valid consideration, we see the net worth of both the parties, and then only we decide who will be the promisee, who will be the promiser. Then you can easily answer this question where you have been asked to pick the incorrect statement. So the incorrect statement here will be both A, your 1 and 2. So C is the right answer. Why? But why? Why statement 1 is incorrect? See, principle of law, it states that the law states that your consideration must move at the desire of your promiser, but it does not have to move from the promisee. Okay, so promiser should be here and promisee will be there. So the desire moves from the promiser to the promisee, not the other way around. And where it has been mentioned, Indian Contract Act under the Indian law, Section 2, Clause D of Indian Contract Act 1872, it clearly states that consideration may move from the promisee or the any other person. This is an exception. Okay, the statement 1 was just an exception to the English law concept of privity of consideration, which is not strictly followed in India. So in Indian law, it is not followed. That is why statement 1 was incorrect. So the statement that consideration must move only from promisee is false under Indian law. Okay, here you can see that it was written that consideration must move. That is why it is wrong. Although it was not mentioned here that we are asking under the Indian scenario only, still it is wrong because it is an extreme statement, and we always in the consent in the consideration move from promiser to promisee. Statement 2 is also incorrect because according to the principle of law, consideration is defined as doing, abstaining from doing, or promising to do or abstaining from doing something. It is broadly defined. What is the nature of consideration? So consideration does not need to be money. Okay, it can be any act. You are performing a service, that is a consideration. Abstinence, forbearing from suing, right? You are not getting sued, or you are being sued, then after that some judgment arrives that you are no longer being sued. A promise to do or abstain from doing something in the future. So all these things are considered under the consideration. Fine. So always remember, it is not about the money, it is about the act. Whether you are acting or not, that is included in consideration. So in conclusion, what we can say that the statement your consideration must always be payment in money or money's worth, that is false. Promise to perform an act is a perfectly valid form of your consideration as well. Okay. Next question, the uniform rules for demand guarantees URDG 758 published by the International Chamber of Commerce ICC apply primarily to which financial instrument? So we have four financial instrument here in front of us. URDG 758 is applicable on bills of exchange, documentary collection, standby letter of credit, or demand guarantees. So always remember, the URDG 758 is for your demand guarantees. Here it is written also, right? So URDG 758 for demand guarantees, and when we talk about the another important one, UCPDC 600, it is for your letter of credit. Okay. So this was it for today's session. I hope that you have learned something new today, and you will try to answer more questions based on your formulas, because module B is a formula heavy module. Last time IIBF has provided us with the clue, with a hint that it is not going to ask only the case study based questions, but it is shifting its focus also on the formula based questions as well. So try to solve them. If you have any kind of doubt right now, do feel free to contact us in the comment section. You can go with the n number of doubts. We will resolve all of your doubts. And if you want to know about the various courses which we are offering right now on DA 247, you can directly contact us on 0981 981 9247. Okay. So see you in the third part. Tomorrow will be